Hi, today my name is Gerald Orlees, and I've also got my business partner James. Just say a quick hi.
Hey everyone, how you doing? I'm James Magnuson with Panax Capital.
Cool. And so this presentation, we'd like to just explain a little bit about our journey with real estate investing. Many of you are looking to convert your actual active income into passive income. And we found that real estate investing is definitely one method for ourselves. And it's also partially active income for us as well. So we'll discuss that in more detail. But Panax Capital is a company that James and I have created, and it's really the main purpose is to assist family-oriented investors to have their hard-earned money go to work for them. This is a disclaimer that this information presented today is for educational information purposes only. It's not intended as legal, tax, or financial advice. So just know that we're going to be sharing personal experience, and this is not in any way intended for you to follow these ideas. However, if you are interested at the end of the presentation, there'll be a QR code. You can visit our website and then reach out to us for more information if you want to have a conversation. So we'll go further into the next slide. This is just my background. I'm one of the founding managing partners here at Panax, and have dual degrees at UC Berkeley. Bottom line, for many of you, you already know my background. I'm on a mission to help as many families be healthy and happy naturally. And I'm the director of a clinic called the Natural Health Improvement Center in Meridian, Idaho. And I also teach clinicians across the country on how to implement functional nutrition and functional herbology. I also assist with them how to identify diseases caused by certain injections as well as pharmaceuticals. That's my specialty. Now, at the very bottom here, you can see that after I graduated from UC Berkeley, I read a book called Rich Dad, Poor Dad by Robert Kiyosaki, which really opened my mind to the concept of passive income via real estate investing. And it started to discuss the difference between liabilities and assets and what is actually an performing asset versus what is a depreciating asset. And so we'll talk about that book in another slide. And James, we got you coming up next. You want to go ahead and introduce yourself and your background?
Hey everyone, I'm James Magnuson. Me and Gerald have partnered up, and I have 15 years investing experience. I have my own LLC and S Corp, done over 70 flips. So I've been a buyer, seller, and well over 100 transaction. Currently moved to Idaho, restarting, and I've acquired two rentals up here. And now getting into the passive income game, your goals start to change, and you go from actively investing and having to hustle and look for deals to being able to have your capital work for you. And that's how me and Gerald have aligned, and we're looking at bigger opportunities with multifamily unit and creating that cash flow, which we're discovering a lot of the wealthy people do, and using multiple doors to increase their stream of income. And that's why we're here to present some opportunities for you today and in the upcoming future.
That's awesome. Cool. James and I met at a seminar training, and it's always about learning. Many of you know myself as a clinician and a natural health practitioner, and I attend multiple seminars and conferences across the country. I even deliver my own seminars, and it's all about just elevating your game, whatever you're in, whether it's in the health field or whatever your profession is, your job, whether it's your family life, if it's investing, whether it's stocks, cryptos, or real estate. And one thing that James and I are also in those other modes of investing. But it's important to know that you're always trying to gather as much information as possible. And James and I have had mentors in the past and partners that would always teach us, and we still do. And we continue to level up. And that's where we always like to share with other people how we have gone upward and been able to level up, because at the end of the day, we can only keep growing when we actually learn from others who are more experienced. So
And I'll say, to add to that, I recently came across a quote. It's upgrade your circle or downgrade your dreams. So to your point, you always need self-improvement and growing and meeting new people that will present you different opportunities. So that's what we're doing right now.
that's awesome. Absolutely. Just dream big, find the right people, and keep growing. So in this book here, we have on screen The Rich Dad, Poor Dad by Robert Kiyosaki. Really, it's a starting point for many people and introduces the concepts of assets versus liabilities. You want to think of liabilities as things that you are responsible for, things that a little bit carry more risk, right? Versus an asset. Assets have risk too, but assets also have the opportunity to provide you value and also income. Now, we'll give you an example. A car would be an example of a depreciating asset, meaning it's you purchase that and you can use that to actually then go and work and travel, live your life, move from point A to point B. However, is depreciating, meaning you're losing money as you own it. And a home that has a tenant in it is an asset, but it is actually bringing you income on a monthly basis, provided that that tenant is paying on time and the house is kept up to par. So we like to focus on cash flow. So oftentimes when we actually acquire a rental property, we want to make sure that the rent is covering the mortgage, if there is a mortgage. Now, I'll talk about in a little bit how my wife and I, we built a portfolio of 13 rentals, of which they're paid free and clear. So there's no mortgages, and whatever rent we come in does go to some of the expenses. So we do still have to pay property taxes, the home insurance, and there are repairs and maintenance that come along with that. And then because we have property management companies, we pay an 8 or 10% fee to them based on what rents are collected, because they assist with actually identifying tenants, screening them, putting them in. They identify what kind of repair work is necessary and what kind of contractors they're going to go ahead and hire to perform the work. So those are things we're going to talk about a little bit more on a slide that I have a breakdown.
I'll add in there how influential that book was for me. I'll talk to you, Gerald. I read that book when I was 16. And after I read that book, I knew that I wanted to acquire real estate. I already had that mindset. I started a Roth IRA when I was 16. Also, my dad showed me time value of money and compounding interest. So when I was 21 is when I bought my first rental. And to your point, that book breaking down easily for anyone that hasn't read it, go pick it up and read it. It's a good gateway into real estate, is assets versus liabilities, and how most people will think their primary residence is their biggest asset. He argues that's your biggest liability because that's your biggest debt service per month. And it gives you the inability to go buy other investments such as a cash flowing business or a cash flowing rental property or anything like that if all your loan is tied up into that primary residence. So it does help you think of a different way with that book. So definitely was influential for me, and I think it's a good recommendation there for anyone to go read.
Absolutely. Man, 16 years old. I wish I had that when I was 16. Looks like your dad gave you some
Yeah.
great lessons. My father taught me some good lessons on budgeting and making sure that I did spend more than what I brought in. But if I had that book earlier, I think I read it when I was 21 years old or so, and it just shifts your mindset. So today's presentation, I hope that your mindset can shift in a direction thinking like an investor, because it starts to open up possibilities.
And I was 21. I'm 42 now. So I've had that property for
Yeah.
20 years. I still own it, and the same tenants are in there, and they've paid off that house for me, and it's worth over $500,000. So they've paid that off for me, and it's still cash flowing to this day.
That's awesome.
Yeah.
And that's a good example. Now, for some of you, you may be thinking like, oh my gosh, how can I get into a property that size? It's you start now, right? You're planting that seed for the future. It's not about trying to amass what we have at this point, but it's about starting at some point. And at the end of the presentation, I'm going to want you to think about, if not now, when, right? Because the earlier, the better. So the best time to plant a tree, it would be today, but it's really yesterday. So some methods of investing in real estate, and we'll break these down, but a lot of these there's overlap, but there's also redundancy, and sometimes they're combined. Now, single family homes, you can wholesale. And if you've ever driven and you've seen on various sidewalks signs that say, we buy houses for cash, this is an individual who's trying to market to someone who has a home or a rental that's vacant and dilapidated and needs rehabbing because it's unsafe to live in. Usually, maybe there's some plumbing issues, maybe there's mold issues, maybe just all kinds of overgrowth on the front yard. So oftentimes wholesaling is where someone can drive around properties in mail and contact the owner and see if they want to sell it for cheap. And then this person sells it to a contractor who does rehabbing. So that's wholesaling. It's someone who's finding properties, selling it to someone who can then rehab it. And then the individual can rehab it and then sell it at the fair market value. So taking a property that's really dilapidated and they acquire it and they rehab it to market value. And then they, of course, have invested the time to conduct the construction, the rehab, the renovations. They put down the capital there. Maybe they have a loan, who knows, maybe they have their cash into it. And then when they sell their market value, then they have those funds to then acquire additional wholesale properties, or they themselves are looking for the properties. And so then the other step is buying and holding. So you can buy a property that requires no renovation, or you buy a property that requires renovation get it up to code that's allowable for you to rent it safely to a tenant, and then you hold it and you collect rents, right? And then property management. So there are many individuals who actually manage their own properties, rental properties. I don't have that kind of time. That's not my active income, but there are actually property management companies that will perform that service for you. So they will go and inspect the property. They'll locate tenants for you, collect payments. They will help you evict tenants. They will provide you updates with what kind of repairs are needed. And then they collect 8 or 10%, depending on the market, depending on how their financial model works, they will collect a percentage of whatever rents you collect. And so there are some individuals that actually will go and find a property. So they're doing partly the wholesaling. They'll rehab it. Sometimes they live in it. And then they will then hold it, move out of the house, find the next rehab property, and then they'll put a tenant in there. And so, in a way, they could be performing all of these steps, which is very intensive. Nothing I ever want to be interested in. And maybe, James, you could tell our audience a little bit what you have been doing within this single column of single family homes there.
I focus primarily on the rehab and flip and then the buy and hold because I'm an end buyer. Oftentimes, to your point, the wholesalers will go get the property under contract and then they go find their end buyer, which the easy way for me to explain that is you can wholesale anything. Like an example, if you go buy a car for $5,000 and you get that car under contract and you can basically sell that contract for 6,000 to someone and create that spread. So wholesalers oftentimes are not the end buyers and they'll negotiate with the seller, get the property under contract and go find an end buyer and create a spread. But I was always an end buyer, so I focused on repair, rehab, and flips, and then my own buy and holds, and still to this day. And to your point, there's different acquisition methods within that, whether you're a cash buyer, you're doing seller financing to structure the deal subject to. I've done a few rentals up here that I've bought recently within the last few months where I did subject to and took over the existing finance. So there's different acquisition models within that, but we won't get into that. And unlike you, Gerald, I actually self-manage on my properties with property management where you defer to put that out to a property management company. So those are two different strategies, but the end result is we're still buying real estate, right?
Exactly. Yeah. And I appreciate you. We've been in the single family residential investment markets in different aspects. And it's important to know all the different aspects to decide you as an investor where you would like to start to operate. You don't have to do it all. You don't have to know it all, but you have to know that, well, each of these are somewhat connected with each other. And if you are not knowledgeable about how to identify properties or how to conduct a rehab or how to find a tenant, it's important to partner up with someone because it's a lot of information to learn. And James and myself have attended various courses long ago. I've attended multiple seminars. We've had mentors that have assisted with this. And our point is not to scare you, but to know that real estate investment does require mentors or partners. And at the end, we'll talk about some easy streamlining options because, again, we're trying to assist with you converting your active income into passive income. And for what James has been conducting for a good 15 plus years is real estate investing as an active income and converting into passive income as well. So with commercial real estate, we have commercial properties. So you see these big anchor tenants in these shopping malls like a Walmart or a TJ Maxx or a Target. And then you have the smaller shops like the UPS. So a lot of these are commercial retail. And then this is our main focus moving forward, multifamily properties. Because when I started building our portfolio together with my wife, we were like, gosh, how much do we need on a monthly basis to be completely free from our W-2, working for a corporation or just no longer needing a job? And I came up with a number, at least 30 homes, right? At least. That would be cutting things tight. But the goal was really 300 homes. And then I started thinking about, well, what's the fastest way to get in 300 homes? Well, how about 300 apartment units? And you can see there are many apartment complexes out there, but where do you start? Who do I look to be mentored on how to move forward with that? And so James and I have really gone about that path of networking with individuals who are successful in this space. We have now our mentors, we have our partners, and we have our courses that we have studied. And we're in active deals now, right? So this is the fastest way to scale what used to be single family, trying to get 300 homes. And we're going to talk about the advantages in another slide of 300 single family homes versus 300 units. There's definitely a difference, and it's a lot easier to scale and faster with apartment complex. Those are multifamily properties. Here are some other niche specialties. These are things you can also develop skills in. Land banking, you can be a developer. It's a long game, and you can identify land that hasn't been developed. And if you understand what it takes to contour the earth, right, move the planet in a way and start developing plans like an architecture, and how much time it's going to take to deal with the local governments to draw permits for these massive projects, then kudos to you. Usually that's downstream when someone has an ambition to take that long game, but these are bigger projects. This is another way of generating leads. So if someone hasn't paid their property taxes, then you can go in there and contact them. Someone can be just a hard money lender. You have a lot of funds and you want to then lend your money out to real estate investors for a percentage, and you start developing note type contracts. So you become a bank yourself. And then REITs are oftentimes a way in which you can use the stock market to invest in real estate, but it's not necessarily, you're relying very much on them as well as the market, I guess you could say the stock market dynamics. All right. I want to talk about an example of a single family home that we have. Now, if we have 13 of these, we acquired properties between the ranges of 70,000 to 130,000. We didn't use any loans, no leverage. And so we had that amount of cash. Now, if you are watching, you're listening, you don't have to invest in real estate at that dollar amount. If you have less, there are many avenues to do so. And there are also many tools and techniques to do so without any money at all. But that requires you to have more knowledge, more skills, more training, and more sophistication. So for today, we're going to focus on, if you're having active income and you have it sitting somewhere, what are some opportunities you can park it into in terms of generating passive income without you learning the trades of the business. So I'll go through this example. This is a single family home for 98,000 that we acquired over in Missouri, Independence, Missouri. And it cash flows $641 a month, and this amount annually. So 641 times 12. Now, the rent we collect is $825, but we have expenses. So we place this rental in an LLC. So when you invest, you want to make sure you protect your assets, because if you have someone that's trying to sue you, litigate, and they want to come after everything you own, they will not be able to touch the asset that's within an LLC that's basically being managed by your C corporation or your property management company. They won't be able to find it. An attorney created this entity, the LLC, Limited Liability Corporation, and on the actual deed of the home, so someone says, I want to sue the owner of this home. They try to find the name of the owner, and it has an LLC's name, which we do not put our name personally on it. We want to remain anonymous. And it has an address that goes directly to our attorney's office. And so if they call the attorney's office saying, I need to know who owns this property, the attorney has to preserve the client privacy relationship. So it basically blocks them out. So if you have a single rental family property, then you can put in an LLC to create that anonymity and to protect your asset. That's just standard information that if you haven't learned about, that right there is going to save you or prevent you from losing quite a bit. Then we also have an annual payment of over $800 for insurance. Now with insurance, it's increasing. And I want you to think about this, because if you have a single family home, and with all these wildfires and these tornadoes and typhoons, hurricanes that are just destroying properties on the coasts of the US, property insurance is growing across the country. And when you get into multifamily home, you start to actually get larger discounts because you're taking one policy out over a large size asset, versus this is one policy on one single family home. So we're seeing actual policies starting to rise between 10 to 20% every year. And so that starts eating more into your profit. So we got property taxes. So this is very dependent upon each state. So certain states don't have property taxes. Certain states have high levels of property taxes. And I'll talk about the markets that we're in a little bit. But for example, Texas doesn't have income state taxes, but they have high property taxes. So it may be a little iffy if you want to decide to invest in single family homes in Texas. This one here is Missouri, fairly low. Right. Then we have the property management fee, which this is 10% of the monthly rent. So you times that by 12. And at the end of the day, from what we paid here to what we're earning annually, the cap rate is 7.8%, which is actually pretty good because we acquired this property about 5 years ago. If we were to acquire a property like this now, it would probably cost 140,000 or so, and that would drop the cap rate probably down to 6%, maybe 5%, which is not favorable because you can go and put your money into treasuries and earn close to 4.5. That's tax free. So it's all about finding something that has a decent cap rate of, and 7.8, that's decent. But when you get into multifamily, that number goes higher than that. Then we have risk exposure. So we had a turn in 2020. 2020 was basically a turn, means a tenant moves out, and we then have the property management company go in and assess what kind of damage has been left, what kind of rehabbing is necessary. And this was massive. It was okay. This is 2,500. We've had a turn that got up to about 4,000. But not only that, we were losing rent for the 4 months, 3 to 4 months, sometimes 5 in a bad case scenario, where they need to do the turn. That can be 1 to 2 months. And then you need another 1 to 2 months to actually put a tenant in. And so this year, we really didn't make much, right? So if we had it completely filled, occupied for the entire year, we would bring this in. But because of that, we lost this amount for that year. So in that year, we only made less than $2,000 just from that property. So if you've got close to 100,000 in an asset and you make 2,000 a year, that is not worth it, right? And that's what the risk is with single family home rentals. If you've got one rental and it's vacant, all your eggs in that basket, and now you're not collecting anything. And so you'll see that many investors will go into duplexes, quadplexes, but why not stop at 4, right? Why not continue going further and higher up? So, all right. So that's an example for us. I don't know, James, maybe you can talk a little bit. Maybe you have an example of, I know you talked about your one property that's worth $500,000, tenant still occupied there. Do you have a smaller property that you worked with?
Yeah, I've had multiple rentals through the years and they go through cycles. The most I had was 9. I'm down to 5 right now, all at different stages. And I want to add one thing for people listening is to your point of single family and how we're explaining how multifamily or getting to will be more advantageous. I don't want to put down the idea of owning single family real estate, right? This is still the gateway, the door to getting to where I've been. For 15 years, I haven't had a W-2 because I was able to acquire, flip, and hold single family real estate. And you always have in your mind is like, hey, I understand one door is great, one single family is great if I can get a 20 unit, but the problem is people don't understand how to get the 20 unit. I think everyone agrees I'd rather get a 20 unit because of economies of scale, multiple streams of income. It's way more risk adverse. So our goal is to say the research that me and Gerald have been doing, how we can position ourselves to getting out of the single family because of what Gerald just described. Although it is better than doing nothing and owning no real estate, a 20 units better than a single family. And that's where we're trying to progress to and grow. So the single family's been great. There's still a lot of appreciation there, a lot of tax benefits. You could have tenant pay down your debts, a lot of things, but there is these expenses, these management fees, the LLC you have to form. It is very active. So we're looking into the bigger units where you can get a lot more passive and get appreciation as tax benefits and just have a steady income. And that's what we're going to start looking at next.
Awesome. So this is the multifamily advantage, right? So with single family, there's limitations that if you have a total vacancy during the tenant turnover, right? If you have to go in rehab, you can't have anybody living in there. That's just not allowable by law, right? So you can't be like, oh, let's rent it out and let's have our crews come in and fix things, and they can move from each room and they can eat out when we're doing the kitchen. They can use one porta potty outside when we're rehabbing the bathroom. You just can't do that, right? You just have a complete vacancy. Higher per unit management costs. So for every single family home, you've got one roof, you've got one HVAC system, you've got one set of washer dryers in there, right? Versus if you have an apartment complex, you can have a couple washer dryer units, and the entire complex is using it because they're not all needing it at the same time. So you can grow with single family homes. It's slower to scale, and just know that more properties need more meaningful income, meaning we drop 140,000 on each home. That's it, right? And it goes into one. Versus if you get into a multifamily real estate property, then you can put 50,000, 100,000, and really now diversify your risks across having multiple apartment units, right? So with multifamily, there's higher cash flow potential because you have multiple rent streams. And we'll talk a little bit about value adds. For example, with an apartment complex, if the cell signal is not very good in that area, you can actually go to a cell phone company and you can rent the apartment complex roof and have a cell phone tower there. And now the cell phone company is paying the landlord or the property owners an actual monthly rent to occupy. So now you have an additional rental stream. If you have a single family home and they got a washer dryer in the unit, you can't charge them for that. That's considered part of the rent, right? It's just there. You're providing that appliance for them to occupy it. But with an apartment complex, you can actually install coin operated washer dryers. And now your tenants are going there and that it's considered an additional stream of revenue. Also, if you have a single family home and there's a garage, then that's part of the monthly rent that the person can actually park their car in the garage. But an apartment complex, you can have in Arizona, perhaps a lot of sun and you get some carports. You can start charging people a little bit more to get a carport versus having the car sit out in the sun, right? So there are different additional streams of income when you have an apartment complex. And that's just a few of them. You can also have storage units because not everyone has enough space in their apartment complex. And so you can start building some small storage units with locks and rent those out. And there's many other add-ons that we can discuss. There's a lower per rent maintenance costs. So oftentimes these apartment complexes, they're going to have the same paint, the same flooring, the same carpeting. And so you can buy these materials at bulk when it comes time to do a turn and just use the same materials and you can have that stored on site. So you're working with scale. So it's definitely lower per unit on maintenance costs. Faster to scale. So that's more along the lines of the financial models, which we won't necessarily go into on this presentation, but you can build your portfolio much more quickly. Now, oftentimes, if I wanted to go get a loan, so our clinic is growing and I want to go get a loan to see what size space I can acquire. In order to do that, I have to show the current assets, my schedule of real estate owned. So I have to show them all 13 properties, what their value is there any debt service or is there a mortgage currently still being owed? How is my business performing? And then from there, they determine what they want to allow me to borrow from the bank. So if I have only 13 homes, I can only borrow a certain amount. But if I'm acquire a portion, I don't have to be the full owner of a 100-unit apartment complex. I could just have a small ownership in it. But when I go to the bank, it'll show that I'm part owner of 100 units. Now I start to scale up as to what I can qualify. And that enables me now to actually get a loan for a much larger property should I want to scale faster. And so there's a lot of efficiencies here that you can look at it and you'll have the recording so you can review these. But the multifamily advantage is something that I overlooked. I never really saw this until I was like, this makes sense. And learning from our mentors and other experienced investors, this makes more sense. And with these add-ons, so when we add on these additional rent streams, we're actually increasing the value of that piece of real estate versus a single family home. Its main mode of appreciation is all about how much is everyone else willing to pay for a home nearby, right? You're looking at comparables. And if the market takes a hit and goes down, single family homes then will lose that appreciation versus with apartment complexes, less likely to be impacted by downstream hits on the economy. And so this method of appreciation is what we call value add or forced appreciation versus the appreciation in single family home is totally dependent on do people really want to move there or not.
And I was going to add, Gerald, you hit it right on the head. I was going to go back to that forced appreciation or increasing, and we won't get into that, but net operating income, such as the multifamily is acting as a business And decreasing expenses, you are forcing appreciation or creating value. And when you start extrapolating that per door, we can get into examples later. You can make a lot of money independent of what the market is doing. To your point with single family, if comps go down, then your value of your property is going to go down. So you can force the appreciation or the value. It's treated more as a business with the cap rate rather than comparable properties. And that is a big advantage right there of the multifamily versus single family, which is what makes it a lot more risk adverse and almost recession proof.
You got it. So there's this African proverb. It says, if you want to go fast, go alone. If you want to go far, go together. And so we went fast with a couple small single family home properties, but we learned a lot and we stressed a lot and we learned some hard lessons along the way. And one of the lessons was the Missouri home. I showed you that. We had that turn to do, and all of a sudden, whoa. So then we thought about, well, we got to go faster. And the mentality is, instead of having one property, what do we need to do to get to four properties? Because if we have four properties and one of them has a vacancy, then the other three are still cash flowing. Great. So then it's like, well, what if one out of four is vacant? Now that's 25% of your portfolio. It's like, how quickly can I get to 10? And now it's really, how quickly can I get to 300 or whatever it may be, whatever number you have. And we each have our own goals. We add our own aspirations, but it's important to have partners. And that's what we've learned, especially when you're trying to take down an apartment complex. All right, understanding some multifamily investments, multiple units is why it's called multifamily. And this can be as simple as a duplex. So there's duplexes, triplexes, threeplexes, quadplexes. And really don't want to stay with there because that's still close to the single family model. I know some individuals will buy a duplex, they will live in one of the units, and they'll rent out to the tenant next door. That's tough because now you're also a property manager and you always say hi to your neighbor and you're always concerned about, are they paying rent? Are they taking care of the property? Are they clogging the toilets? What's going on, right? So that is not a situation I want to be in personally. You yourself as a passive income investor probably don't want to deal with toilets and tenants and taking out the trash, for example. However, multifamily does include 100 units, 200 units, 500 units. So there's definitely the scalability and the benefits of scaling upward. And then there's the income potential. Again, we mentioned the multiple rent streams. Market analysis. Now, it's very important to understand that the properties that we choose they have to be ideally in a good area. Now, I know James and I have had properties in, I guess you could say, tenant-friendly states. And then there's landlord-friendly states. And we currently are now moving forward, always trying to find what is a better market to invest in. And looking at property selection, you start with location. I'm going to start with what states are really growing. Well, you want to look to see where are companies moving to. So companies are moving to the Carolinas, Tennessee, Texas, right? And then you also want to look for areas where manufacturing is starting to revive, because now we're seeing a revival in the manufacturing industry, and we're trying to see where do we have workers needing a place to live. And so other states would be like Alabama, Oklahoma, Arkansas. Maybe you start seeing Ohio. And so these specific markets are not only landlord friendly, but also growing and developing. So many of you know that James and I actually both moved away from California. If you look at the population numbers in California, it's declining. And so what does that mean? Probably not the most ideal place if you're looking to start in real estate investing. There are still deals to be found, but they're going to be harder and they're going to be more competitive, and they're going to require you to have a lot more capital because of the overinflated pricing of a lot of the properties there. But really start with, where are you going to invest? And then from there, what kind of properties do you want to invest in? Do you want to invest in single family, duplexes, quadplexes, apartment complexes of 20, 100, 300 units, right? So that is where you start. And then you start gathering all of this data. And from there, you can decide your markets. So if you're interested in knowing which markets James and I are focused on, you can go ahead and reach out to us. We'd love to have you in actual conversation. But certainly those states that I've mentioned, the Carolinas, Tennessee, Alabama, Texas, Arkansas, Oklahoma, Missouri, those are markets that are definitely on our radars. And then we go even more precise with actual counties. Here's some of the, we mentioned the value add-on opportunities to force the appreciation. Well, you can do physical improvements, renovations, upgrades, curb appeal enhancements. The whole concept is when we acquire a multifamily property, we actually want it where the rents are below market. And the reason why a landlord will keep the rents significantly lower is because maybe they own the property and they don't have any debt service. They don't have a mortgage, and that's fine. I'm fine just giving low income housing to anybody. And they're now done with the property. They're like, oh, you know what? I want to sell it. I want to cash out. I want to move on. And so whenever we're looking at an apartment complex, we're looking to see, well, is the occupancy at 95% or closer to 100%? The higher the rate of occupancy, most likely the lower the rent is from market value. And so if we acquire a property that is $300 to $500 a month less than market value, we have then the next 3 to 5 years to slowly raise that upward. And that right there is already an actual opportunity for increasing or creating forced appreciation. You can also start creating premium units. So you can have a subsegment of your apartment complex being a platinum level, while all of your others are silver and gold. So you have that type of leverage and latitude. You can move the property upward in certain directions. Also, we want to see sometimes if we can acquire property that has poor property management. Oftentimes, if you have a property management company that's underperforming and the landlord doesn't know it, you have tenants who are writing bad reviews, tenants are moving out because they didn't get their toilets fixed within. Imagine you have a toilet and it's leaking or it's clogged and you need assistance in repairing it, and the property management takes 3 or 4 days, right? Or your fridge goes out and it takes 5 days to replace it or fix it, or your air conditioner is out and it's 105 degrees every single day and it takes 2 weeks to get that fixed. That creates problems. So oftentimes we'll look at a property to see, well, how good is the property management company? And then go in and acquire that property and install a more effective property management system that can be done on site or having a better company manage it, right? So these are opportunities that we look for. Reducing expenses. Sometimes we'll see that some properties are offering the tenants unlimited. Basically, the tenants are not paying the gas, electricity, or water. And because the actual apartment complex is not metered that way. And so if we acquire a property that enables us to then put sub meters on it, you see now the expenses come down for that particular property that we as owners no longer have to pay, right? And we put specific meters and now we have those expenses passed on to the tenants. And so this is another way to improve the profit margin, right? So the profit margin is taking your income and then taking your expenses and then decreasing those expenses while increasing the income. And that margin enables us, as well as all the investors involved, to generate profit. There are many other things involved with that, but just to give you an idea, is we're always trying to increase revenue, decrease the expenses, and when we look for deals, that's our focus. Anything you wanted to add, James, on that?
Well, just I know what I thought in talking to people. A lot of people think, well, you come in, it's 300 to 500 under market. We're the big bad company or corporation that just starts increasing rents. Ethically and morally, people think that, and that's not what happens. In fact, normally when rents are under market, that means there is a lot of neglect on the unit. The owner just treated it as a checkbook. They didn't actually take care of the property. There's a lot of deferred maintenance. And you got to remember, those increases happen gradually. And normally, most people are proud to pay a little more because the first improvements you do, a difference from single family to multifamily, single family, you focus on the inside and a homeowner will take care of the outside. On multifamily, we're learning quickly the most big companies, they will do exterior renovations first. So we'll add cameras to the hallways, parking lots that need to be paved, storage units. People want pride of ownership within the building they live in. So part of increasing the rents is also CapEx budget and beautifying the place that they live. And that actually is a wanted by most of the tenants that are there. So I just wanted to add that in. As you're increasing rents, you're creating something that we're proud of to offer and that the tenants are proud of also.
Very well said. And James mentioned a term called CapEx. That's capital expenditures. That's essentially a budget that's intended to enhance the property, whether it's appeal or the function. Sometimes you'll see these units, and I've lived in some apartment units before, and I've been to them. I'm like, wow, this place is really nice to live in. Of course, then the rent is a little bit more higher than if I go down the street and they don't have that lounge that's rentable. They don't have that pool that can be shared where you can have all kinds of birthday festivities or relative events. So building your multifamily portfolio, always start small. You could start with a duplex. You could start with a small apartment. You could come in as a limited partner investor on a bigger deal where it's completely passive as well. So we have a lot of limited partner investors that will choose a certain amount and they say, hey, just hold this in this investment project for whatever time from 3 to 7 years. And I just want to go and focus on my active income, my daily job. And in 3 to 5 years, then they're generating an annual return, which is deal specific, but you can think about on an average range that if someone were to invest approximately $50,000, then leave that for 5 years and on an annual basis can earn a range between 14 to 19% or so. Again, it depends on the deal. It's very specific to that, and how those details go down is something that we can discuss on a separate call individually. So start small, though, whenever you're building a portfolio. Like I said, we started with one house, one rental. Then we went to two, then went to three. Then we had a bump up because we left California, sold our house, and took that equity and bought 3 properties right away, right? So it's all about starting with one and then moving forward with the next investment deal. Then you want to also diversify. So the single family homes that we actually currently own and we invest in are in certain markets. So we have a couple in Indiana, Georgia, Alabama, North Carolina, Missouri, and Arizona. And I know I'm thinking of some other places, but a bulk of them are in Alabama. That's area is growing. Now, this is for single family homes. Some of these markets are still applicable for multifamily, but again, it's very market specific. And the reason why we chose those markets is because that's where our current property management companies are focused on servicing properties. So if you actually have a property that is considered an investment property of yours, and you're going to want to make sure that if you're not managing it, you have a good property management company handling the tenants and taking care of the repairs as quickly as possible. So that's how we decided where we were going to focus on. And so now when we discuss benefits of multifamily investing, okay, so we're looking at strong cash flows, equity appreciation. Now, this is through the forced appreciation of making proper to the property, as well as installing any value add opportunities. So that could be installing cell phone towers, coin operated laundry, storage units, parking spaces, etc. There are definitely tax advantages. So when you invest with us, or you actually invest in actual ownership of a property, you're going to want to have an entity and you're going to want to have it structured correctly. This presentation, we're not going to discuss what the use is for a C corporation and then a holding LLC and then LLC to create anonymity, but that's a general basic structure you're going to want to have. And there are many tax saving advantages that you can have with a C Corp. So with a C Corp, you can have, I think it's a 105B, where you literally can expense any medical expenditure and that basically tax-free, right? So we use that also for our travel. So I was recently out of the country and we use our C Corp, which is our management company that covers all of our trips abroad, provided that we are abroad looking at something real estate related during a portion of the trip, right? So you have a lot of tax advantages. Now, keep in mind, for many of us, taxes are our number one expense. A lot of people don't even think of tax as an actual expense, but it is. So you're trying to minimize that expense as much as possible. And then multifamily apartments are more resistant to economic downturns. Okay, typical deal structure. You wanted to join us, and again, we have upcoming deals. You can talk to us one-on-one. 50,000 minimum. And from there, you can go in increments up to 25,000. And for that amount, we'll locked in for a period of 3 to maybe 6, 7 years, depending on the deal, so that the property can be transformed. Okay. So we go in, we see an actual property, and it's going to take time to stabilize in the beginning, installing better enhanced property management personnel in there, making sure that we provide the proper rehabbing and making sure that the property is actually on the whole being elevated and the tenants are feeling like, okay, this place is to a better place. And then if there's an opportunity to slowly increase the rates towards market, then that starts to take its place as well. And usually we're going to have preferred returns between 15 to 19% annually. There's we call it the waterfall. There are certain priorities or certain investors that get a higher priority. And usually a limited partner investor will come in at a higher priority to ensure that they're going to get paid out at the right once we exit from the property. And we have equity split, meaning that 70% is usually the limited partners. So these are the people who are coming in and be like, hey, you know what? I just want to be a passive investor. And then the 30% goes to the actual general partners, the people who are actually finding the deals, actually putting their name on the loan, because to acquire a property of this size, there's a fairly large loan being taken out. So they're taking the majority of that burden and risk. And then also there is the management of the property. So the property manager, also known as the asset manager, they are very active during the course of the 3 to 6 years of installing the proper personnel, training them, making sure they're performing high level property management tasks so that every tenant wants to stay there. Every tenant is having a great living experience there. And that right there is the 30% is the general partners there. Okay. And then the strategy is usually oftentimes either refinancing the property or selling it altogether, where then all of our investors receive their actual dividends and then they are able to reinvest that in additional projects thereafter. All right. Anything I missed there or anything you wanted to add, James?
There's a lot even on the last slide, but
Yeah.
it's just much information. We got to do this again, but this is a good start, and it's been fun working with you because you're so detailed and focused, and I'm been bitcher. Even with my I step over the pennies to get to the nickels and quarters, as the saying goes. And when you look at these type of things, such as the equity split, a 70-30 investor general partnership split means anyone investing that is passive gets 70% of the overall revenue and profit of the building. So actually the people doing the work that are not passive, that are active, only get 30%. So that's the power of this. And then furthermore, your last slide that talked about the benefits, when you invest in multifamily, which is different than single family, as a LP or passive investor, you actually get depreciation. So when you talk to your tax advisor, whatever percentage of this building you own that you invest into, you will get depreciation, which is a huge tax benefit. You don't have to do any of the work. You just collect your 15% and you let someone else manage it. On top of that, you are getting an institutional grade investment that you could never afford by yourself. So you're getting the security of investing in a building anywhere from 3 million to $20 million, which is what we're targeting. You're getting the security of many doors, that asset recession proof, while you're getting tax benefits and not having to manage anything. And you're getting 70% of everything and preferred returns, which means it's paid in order of, you said waterfall. It's typically mortgage and then preferred returns. The partners don't get paid until everyone else makes money. That's why a lot of wealthy people will start investing this way, or passive people that have their own W-2, that they'll go ahead and put in these investments and get that deferred write off of interest, and they'll get the upside of a multi-million-dollar apartment unit. It's pretty powerful once you start to look into it. And there's a lot more factors that we'll talk about later. And number one being, me and Gerald's job is to find good units or good operators, but that'll be a discussion for another day.
Nice. Okay, so there are some upcoming opportunities, and these are things that we discuss with individuals who are part of our investor club. So you can have in Dallas 176 unit, Phoenix there's a 224, Atlanta 320. So these are just examples of certain projects that are coming up. But if you are interested in, and we have some others that are not listed here, but if you are interested, you can give us a call, send us an email, and we can actually schedule some time. You have the QR code here. This takes you to our website. You can reach us out there. Obviously, this is for friends and family, so you should have our direct contact information. Obviously, we're family-oriented investors. We want to make sure that not only is your family being taken care of for generational health, but you also have a path and a plan to help your family generate wealth. We're in this world and we're working hard not only for ourselves, but make sure that our kids are taken care of, and our kids can also learn the lessons that we're learning, because at the end of the day, we want to pass this information on. So I want to say that you can scan this, you can just reach out to us afterwards. And I want to say thank you for taking your time. Anything else you wanted to add, James?
No, that was fun. I enjoyed doing that. I think we should schedule some more and yeah, just looking forward to continuing.
For sure.